investing in property makes sense, investing in the right property takes knowledge. Welcome to the Rewarding Property Decisions podcast. I'm Jared McCabe, Director of Wakeland Property Advisory. Join me for expert insights into the fundamentals, trends and opportunities to help you create long-term wealth through smart property decisions. Hi everyone, and welcome to episode 28 of the Rewarding Property Decisions podcast. So as I seem to say most weeks, it's some interesting times in property at the moment, particularly within this country. Over the last 2 years, we've obviously seen some pretty strong market growth within the housing sector, more particularly across the country. However, towards the end of last year, 2021, and certainly into this year, things have started to change a little, and particularly in Melbourne. Now, as is usually the case with the media, you'll see that it's one extreme or another. So last year it was that everything was unaffordable and we were focusing very much on the high clearance rates, the strength of the growth rates that were occurring. But in more recent weeks, that's starting to that trend is starting to reverse, and we're now starting to hear that the Melbourne market is changing to a buyer's market. Prices are being discounted, they're falling fairly significantly. Now, they're definitely not as strong as the prices rises that we saw last year and the surging levels of demand in 2021, but we're definitely not in a buyer's market. A better term is probably that we're starting to rebalance and get back into more of a balanced market rather than favouring buyer or seller. So what we've found over the years is a good way to examine this trend and see where things really are sitting is to look at auction numbers, but also take into account the clearance rate. I think if you look at them both independently, you can be a little bit skewed, and they're not the be-all and end-all to give you an exact picture of the market, but there's certainly a good starting point as to what's going on. So if we look over the last 2 to 3 years, perhaps even as far back as early 2019, at the supply levels that we've been seeing auction-wise across Melbourne, you can start to see how things are going. The patterns probably across each year haven't been as consistent as they normally would be. You can normally see the Melbourne market, how the supply levels work, when they're stronger and when they're weaker. And particularly during the pandemic, that's changed a little bit. It's been a bit more up and down at differing times of the year as the lockdowns, particularly that we've experienced in Melbourne, have impacted on what we can and can't do. So there's had to be a little bit more flexibility, and people have had to pivot to make sure that they can keep up with what's going on. So, but if we look back at, say, 2019, 2020, 21 and 22, if we look at that first quarter for each year, generally each of those areas, interestingly enough, haven't had too many interruptions. We've tended to find from a property perspective that we've been able to transact. There may have been some restrictions, but we've generally been able to inspect properties and therefore either conduct auctions online or in a lot of instances in person as well. So if we look at those, the interesting thing is that back in 2019, which was prior to the federal election in May that year, when the market started to turn after that, at the time, surprising result, numbers were certainly down in 2019. On average for the month, they were below 1,000 per weekend. And if you look at that compared to 2020, which was around 1,100 per weekend, 2021 was around 1,200, and this year we've actually averaged around 1,300 per weekend for the first quarter. So it's pretty strong numbers and continuing to grow. But to gain a little bit of context, that looks at the supply side of things. If we use the clearance rate to sort of analyse the demand side, it again starts to paint a picture. 2019, we were very much in the more balanced or perhaps even more of a buyer's market where the clearance rate was sub 60%. 2020, we were hovering around the 70% mark. By 2021, we were pushing right up into the 80% mark. And this year, we're sort of high 60s, low 70s, depending upon how the weekend's gone. So it's showing you that we are still in a pretty good market. Over the years, we've tended to use a back of the envelope or rule of thumb as a bit of a guide, where If the clearance rate's above 70%, we would consider that to be a seller's market. If it's sitting in the 60 to 70% range, it's typically a fairly balanced market. And if it's sub 60%, you tend to find that you're in a buyer's market. So if we're sitting at the moment in the high 60s to early 70s, we're probably moving into a balanced market. But even some weekends, it's still probably slightly favouring the vendor or the seller. So by no means are we at a buyer's market at the present time. It's certainly starting to cool, but that was certainly needed after the strength that we've experienced over the previous 2 years. And there's been a number of reasons for that strength and why the market's been so positive over that period of time. We certainly entered the pandemic in March 2020 off the back of some fairly strong growth through the second half of 2019, and that meant that the market, whenever it could act during 2020 and 21 was pretty strong. There was pent-up demand there where buyers felt as though they kept being locked back and not being able to transact. So when they could, they were pretty desperate to get a deal done. Obviously, interest rates were extremely low and still are. But those pent-up demand levels certainly helped. There was because we spent so much time at home, the lockdown really made a lot of people focus on their home and whether or not it was suitable for what they were after, or whether they needed to make some changes and some upgrades. And because there wasn't, as we've heard there wasn't a lot of opportunity to spend money on anything but. So there was a lot of saving going on, which certainly meant that people did focus on spending on their homes. But those strength levels that have been there over the last 3 years were never going to be sustainable long term. It was always going to get to a point where the lockdowns, so to speak, dried up the demand. Interest rates are now highly likely in the second half of the year to start rising. The elections, the federal election, which is coming up, and then the state election later in the year for Victorians, whether property, and this year it's not likely to be as hot a topic as it has been in some past, but it still does create a level of uncertainty for any property participants, so whether you are a buyer or a seller. And so people do tend to sit on their hands and hold back a little bit to wait and see what happens. And then obviously there's broader economic uncertainty as well, with obviously the unfortunate issues that are going on over in the Ukraine at the moment. And part of that is driving inflation levels that are a lot stronger, and petrol prices going up, that sort of thing, which again just creates a little bit of uncertainty and people tend to hold back a little bit. So these are reasons why the market's starting to cool a little bit off the back of what we have experienced over the last few years. But the balancing of the market does have a number of benefits, particularly for buyers. It creates a bit more normalcy than what we've perhaps been experiencing over the past few years, and certainly makes things far more balanced and gives some good opportunities. Underquoting is far less of an issue now. Vendors' expectations are typically closer to where the end sale price would be, whereas last year, and certainly 2020 as well, we were finding that vendors' expectations were realistic for the time, but the eventual sale price more often than not was soaring past vendors' expectations, and that creates the underquoting discussion that always arises when the market starts to move up. And then if we look at, there's far less fear of missing out, so the FOMO analogy that we hear a lot about, buyers aren't suffering from that as much. They're far more content to buy a property if it's at the right price point and if it meets their requirements. But if they feel as though a vendor's expectations are too high, then they are more than happy to sit back and wait, as opposed to last year where there was a real desperation. So they're far less rushed than what they were, and not feeling as though they have to make a decision right here, right now. So if I'm providing some advice to both vendors and buyers, if we look at the vendor side of things first in terms of selling in the current market while it is rebalancing, I would say don't rush. There's plenty of demand around for good properties, and we are still seeing that there's good competition around at auctions. It's not always the case, but it is still there. Don't get caught up listening to commentators who are predicting significant downturns and dramatic changes in the market. It's not likely to happen. But when you are setting up your campaign, try to avoid disruptions as much as possible. So things like overlapping or being around one of the elections, or particularly if your property might be suited to families, that sort of thing, you need to be mindful of school holidays. Public holidays can always be a bit of an issue too. So just try and where possible, avoid those disruptions to your campaign. And also really understand the market that you're working within. So what are some of the things that are impacting on it? Who is your likely buyer, and make sure that you're catering to them and giving them every opportunity to purchase your property and compete for it, whether it is on at an auction or whatever other method of sale you're choosing, so expression of interest, private sale, that type of thing. The other thing I would say is you need to have conservative expectations in the current market. What we've seen time and time again is that vendors who have got very bullish expectations on their property, as I said earlier, buyers are very mindful of that, and they are more than happy to sit back if they don't feel as though a property is at the right level value-wise. So you need to have a conservative mindset. It doesn't mean that you should be expecting to sell your property for less, but if you don't have a conservative mindset when going into the selling process, you might find that your property sits there for a long period of time. So if we move to the buyer's side of things and providing them with some advice in terms of purchasing during a rebalancing market, don't expect to pick up a property at a bargain. Good property will still have competition. It's why it's considered a good quality property in the first instance. So if you're going in with a bargain hunting attitude, you'll find that you'll continually miss out on properties. And then when you start to do your planning and things, prepare for interest rate rises. They are highly likely to occur in the second half of this year. So you need to factor them into your calculations and make sure that you know that there could be some changes to your mortgage repayments on a monthly basis. And if you're prepared, you can really take advantage in this current market. Being able to have flexibility, offer terms that perhaps, if you can be flexible around those and a bit more in keeping with perhaps what the vendor is after, particularly when you're working within an off-market private sale or on pass-ins, you can really take advantage if you've got a degree of flexibility around your terms, and then you can crunch a bit harder on the price side of things if you have got that opportunity. And then bear in mind too that the market is unlikely to run away like it did in 2021. So the FOMO should be far less of an issue for you. And if the property isn't at the value that you see and think that it should be at, then you can take a step back and make sure that you get you get it at the right price. There's far less of a concern at the moment that if you don't buy right here, right now, that in a month's time, the property could be worth 2, 3, 4, 5% more than what it was at the date of previous purchase. So there's the really important key factors to remember when buying property in this market is, as always, asset selection is still absolutely key. You've got to buy the right property, but you've also got to understand the purpose of your purchase from the start, and that factors into that buying the right property. So really have a clear understanding of what the objective is so that you make sure that you are buying the right property. It's always still a long-term exercise, so that trying to finesse things too much around pricing can really do you more harm than good. And just don't expect a bargain. Make sure that you're there ready to pay a fair price, but when it comes to the negotiation, you crunch and push as hard as you can. Set your budget, work within it, and don't push yourself too hard. But as I said before, don't finesse things. But if you need to spend an extra $10,000, $15,000, $20,000 to get a good property, in the long run, you'll be happy you did. So from a case study perspective for this week, looking at a property that we actually helped a client sell fairly recently, and it was it was in what many considered to be a buyer's market or a flattening market. And this just goes to show you that just because the market's starting to soften doesn't mean that that things aren't still going quite well. So this property had a number of perceived compromises with it, or things that may have held it back. It was in a good suburb, but it was on a main road, so that can obviously be an issue for some people. It was abutting a laneway. Sometimes that can be a bit of a concern from a security perspective. Also abutting commercial property, and it wasn't a typical style of home for this suburb. But the campaign actually did go really, really well. We didn't have huge numbers through the open for inspections, and that's not unusual when you've got a property on a main road. But we did have really good quality inspections. People were really engaging with the property and really feeling as though it met with a lot of options. So it was a good affordable entry point for many buyers to get into this market. The day of the auction, we had a crowd of 30 to 40 people. So again, not huge in terms of numbers, but we ended up having 5 bidders and the property ended up selling for over 10% above the vendor's reserve price. So it's a property that potentially is compromised, that is selling in a market that's softening, but still has really good competition and goes very, very well. So it does show that we aren't necessarily, just because the market might be starting to change doesn't mean that you can expect bargains or expect to pick properties up at below market values. So that's about it for this week. Thanks for joining me for episode 28 of the Rewarding Property Decisions podcast. As always, please feel free to share the podcast with family and friends and colleagues. We'd like to keep pushing it out as far and wide as we possibly can. And if you would like any further information on how to make rewarding property decisions, please visit our website, wakeland.com.au, and we wish you all the best with your property decisions.